Hello and welcome. In this video, Forex for beginners, I will teach you the things that you need to learn before you start your trading journey in Forex. I'm going to assume that you are a complete beginner to the world of Forex and explain the concepts. So make sure you watch the entire video before you jump into the world of trading. Alright? So without further delay, let us start our first section, which is where we answer the question, what is Forex? Forex stands for foreign exchange. Okay? Foreign exchange is equal to Forex. Now, let us understand the mechanics behind Forex with the help of an example. Alright? Let us say this person is you. This is you. You are from India. You are from India. And the currency of India is INR, Indian rupee. Alright? So this is the currency of India, your country. You have a friend in the United States of America. Your friend is in the US. Okay? Now it has been a long time since you have visited your friend or your friend had visited you. So one fine day, your friend asks you to visit him or asks you to come to America and spend some days there. Okay? So he calls you to his home. Upon thinking, you decide to visit him. You think that it would be a nice trip to America and you decide to meet him. Alright? But then the problem is the currency that you have, the money that you have is Indian rupee. This is fine for transactions in India. But you cannot take INR or Indian rupees to America to spend there. Because the currency of America is USD, United States dollar. The shops in America accept only the dollar. So that is the problem now. There is a problem which needs to be solved. You need to give your rupees and get dollars. Alright? To do this, we have currency exchange banks. So what you do is, you go to a currency exchange bank to give your rupees and get American dollars instead of that. Okay? Now let us say that the date is August 1st. On August 1st, you visit a bank. When you visit there, the person at the bank says that the exchange rate as of today is this. 1 USD is equal to 80 INR. Meaning, if you want to get 1 American dollar, then you have to give 80 rupees. If you give 80 rupees to the bank will give you $1. So this is the exchange rate as of August 1st. So you say, okay, I have 80,000 rupees. This is the money that I'll be taking there to spend, but then I want it in American dollars. You say that to the person at the bank and you give him 80,000 rupees. According to this exchange rate, he gives you 1,000 American dollars. Alright? Now, what has happened here is the conversion of one currency to another. The conversion of INR to USD. This is exactly what happens in the Forex marketplace. Okay, more on this in future videos. Now, you have your $1,000 and you are happy with it. You take that $1,000 and you visit your friend who is in America. Okay. Now your friend is kind, your friend is rich too. So he decides to take care of all your expenses. He doesn't allow you to spend even a single dollar. So during your entire stay, you do not spend any money. Alright? So the $1,000 that you had taken to spend in America is exactly as is. Alright? Now, after staying at your friend's house for a month, you decide to return to India on September 1st. So on September 1st, you return to India. Alright? Now, here, the problem once again is, you have $1,000 with you. This is the currency of America. The currency of India, to which you have returned now, is INR or Indian rupees. You cannot transact in India by paying USD. If you go to a shop and buy something and if you pay it using United States dollar, the shopkeeper will not accept it. So what you need to do is go back to the currency exchange bank and exchange the USD for INR. Okay? So you do exactly the same. You visit a currency exchange bank to give your USD, 1000 USD and get back INR. And let us say that you do this on September 1st itself. When you go to the bank, the person at the bank looks at the exchange rate. And as of September 1st, the exchange rate is this. 1 USD is equal to 82,000 INR. Sorry, 82 INR. Meaning, if you give 1 American dollar to the bank will give you 82 rupees. This is the exchange rate as of September 1st. How much money do you have? You have $1,000. So you give $1,000 and according to the exchange rate, the person at the bank gives you 82,000 rupees. So you have received 2,000 rupees more than what you had given before visiting America. Correct? Before visiting America, you exchanged rupee for dollars. You had given 80,000 rupees to get $1,000. But now, due to the exchange rate variation, $1,000 is getting you 82,000 rupees. So there is a profit of 2,000 rupees. Correct? So you are happy now because you got 2,000 rupees more. Now, what you think is right and wrong too. Because, of course, you made a profit of 2,000 rupees here. You are right in this part. But what has happened here is the Indian rupee has become weaker when compared with dollar, or the dollar has strengthened when compared with Indian rupee. Alright? So this is why you need to pay more rupee to get a dollar. All right. Yes. So why does the exchange rate change? Why did it change from 80 to 82, 80 rupees to 82 rupees? Why did that happen? All these things we'll see in detail in future videos. Alright? I hope you have understood the concept of exchanging currency. So what has happened here too is currency conversion. The currency of American dollar, the currency American dollar was exchanged for INR. This is exactly what happens in Forex marketplace. What we basically do in Forex trading is predict if a currency will strengthen or weaken when compared with another currency. Okay? Yes. Now I won't tell too much about this and confuse you now. We'll see about this in detail in future videos. Alright? So this is enough for this section. Let us move to the next section where we will learn the features of Forex market. The Forex market is the most liquid market in the world. Now, what do you mean by liquid? It means that a lot of transactions happen in the world of Forex. The last time I checked, it was around $7 trillion per day. So that is a very high volume when compared with the stocks. Alright? You might have been trading in stocks or the derivatives. The volume of Forex is much more than the volume of stocks being traded. Alright? Now this is a good thing. This is a good thing as you can enter the market and leave it whenever you want. If you are a buyer, you will get a seller for every price. If you are a seller, you will get a buyer for every price. Whereas if you consider the world of stock market or the derivatives, if you are a buyer, sometimes it will be difficult for you to find a seller who is willing to sell something that you want at the price that you want to buy at. Okay? If you are a seller, sometimes you may find it difficult to find the buyer who is willing to buy at the price at which you are trying to sell. Alright? Whereas in the case of Forex, that will not happen. So, a lot of trading happens in the world of Forex, mainly because we are having currency as the asset here. If you take FIIs, if they want to invest in another country, then they would have to trade or exchange their currency for the currency of the country where they are investing in. Okay? Tourists, if they are going to a different country, then they will have to exchange the money too. All these contribute to the liquidity of the market. Alright? Now, when we have very high volume being traded in Forex, it becomes difficult to manipulate the price too, which is a very good thing. If you consider the world of stock market, if you want to manipulate the price of a stock, you can do it. You meaning someone with a lot of money, not retail traders. Someone with a lot of money can move the price of the stock in the direction that they want. But here, in the world of Forex, you need extremely high volume to move the market in the direction that you want, if you want to do it. Generally, that kind of volume will not be available with anyone, all right, even with a person with lot of money, because we are trading against banks and prop firms here, and they do not allow the price to be manipulated. All right? Yes. So Forex is the most liquid market in the world. Next is, in the Forex market, when we buy a currency pair or when we sell a currency pair, what we are actually doing is we are betting or we are predicting if a currency will strengthen or weaken when compared with another currency. Okay? We are not actually buying a currency and exchanging it with another currency. We are just trying to predict whether a currency will strengthen or not. Alright? More on this later. Now, this, I have taken this as a point because there is a misconception among people that they think that we buy the currency and or we sell the currency in the Forex market. No, it is not like that. We are trying to predict if a currency will move up or down when compared with another currency. Okay. Next is, in the Forex market, traders are in for the short term. If you consider the world of stock market or some derivatives too, traders are in for long term. Traders who are in for long term are generally called as investors. In this world of stock market, people come with their money, invest on stocks and wait for months and years for the stocks to grow and to get the return. If you consider the person who is trading futures, then he might have invested money and he might have been trading it for months. Same goes for the options too. If a person is trading options, he might be holding it for a month. Whereas in the case of Forex market, traders are in for the short term. We have day traders who open their position in the beginning of the day and close it by the end of the day. We have scalpers who are in and out of the market within minutes or seconds. And then we do have some swing traders who hold their position for a few days, but it is rare. Okay, but they are there, right? But anyways, traders in the Forex market are in for the short term when compared with other instruments. All right. Next is that Forex market trading incurs less transaction costs when compared with others like stocks and derivatives. All right. The transaction cost for Forex trading is very less. Then the Forex market is a 24/5 market. Okay, Monday to Friday. We say 24 because at any point of time, a market from a country will be open. It may not be from India. Some other country might be open at any particular point of time. So if you take, let us say, morning 9 o'clock, some market of some country will be open. If you take at 11 o'clock, some market of some country will be open. If you take evening 5 o'clock, some market of some country will be open. If you take midnight, some market of some country will be open. So, at any point of time, some market of some country will be open, and that is why we say it is a 24/5 5 market. Okay, Saturday and Sunday would be no transaction day. All right. Next is that you can get high leverage for trading in forex. Okay, meaning you can trade in forex market with less money or less capital. All right. So these are the features of the forex market. Now the question comes, who trades forex? Generally, we have three main people. One is banks and institutions. Banks and institutions trade in forex. All right. They are the one who move the market. They are the one with a lot of money. They cause changes in the forex market. Okay. Generally, if you think of banks and institutions, they are trading with the money of the people itself. Okay. When people keep their money in the banks, they give interest to the people for keeping the money, correct? But what do they do with the money that the people keep? They trade forex. Okay, not only that, they do many things, but out of that, they do this too. Okay, so using people's money, they trade in forex. Okay, and they have their own money too, so they use that too. They trade forex. There are financial institutions who trade in forex too. There are hedge funds who trade in forex too. Okay, so banks and institutions who have a lot of money are able to place orders of high volume which can move the price. Okay, next is prop firms. Now these are firms which have traders working for them. What they do is they collect money from people and trade on their behalf. And whatever profit they get, they share it among those who have given money to them and also the traders who are working for them. Okay, so they are trading in large volume too. And then we have retail traders, people like you and me. We do not have the capacity to move the market, but we are in the forex market to make money too. All right, those are capable of moving market with high volumes are banks, institutions, and prop firms. Okay, if you think of it, the price in the forex market actually moves due to traders of all sorts, because they are the ones who are entering the market at certain locations, all right, and leaving the market at certain locations. So they are the ones, along with the news, who move the market. Now, when we say news, every country has their economic data, and every country will be releasing their economic data often. So, as and when news gets released, it will have an impact on forex market. The economy of the country impacts the currency of the country too. If the economy of the country is stronger, then the currency becomes stronger. If the economy goes down, meaning it weakens, then the currency of the country weakens. Okay, so these, along with the news, move the market. All right, I hope it is clear. I think this is enough for this section. In the next section, we will learn about currency pairs. All right. In the world of Forex, we trade currency pairs, and a currency pair looks something like this. Now, what is a currency pair? It is one currency paired up with one more currency. So, here euro currency is paired with United States dollar. Alright, and we write it like this, EUR/USD. The currency that is to the left of this currency pair is called as base currency. The currency that is to the left of the pair is called as base currency, and the currency to the right is called as quote currency. So, whatever pair you may see, the currency on the left side will be the base currency, and the currency on the right side will be the quote currency. Okay. Now, if you look at the Forex market, you will find the currency pair with a quote value, or like this. For example, okay, you'll find currency pair with a quote value. Now, what does this signify, or how to understand this? Now you know that the currency on the left is called as base currency, and the currency on the right is called as quote currency. Now, this is a value. What this value says is how much units of quote currency is required to buy 1 unit of base currency, or in simple words, we need $1.0883 to buy 1 euro. Or in other words, 1 euro can get you 1.0883 American dollars. That is what it means. Okay, this is called as exchange rate. Okay, so what does this say? This says how many units of the quote currency is required to buy 1 unit of base currency. Okay, now this is EUR/USD. You can invert it, or you can flip it to get something like this. This is USD, EUR. In this case, USD is the base currency, the one to the left, and EUR is the quote currency. And we get this value, which is 1 divided by this. You don't have to remember that. But how can you interpret this? This is how many units of quote currency required to buy 1 unit of base currency. Or in simple words, you can think of it like this. 0.9189 euros are required to buy 1 US dollar. This is the exchange rate of this. Okay, I hope you get the point. Let me take one more example of USD and INR. USD is American dollar. This is the base currency here because it is to the left. INR is Indian rupee, which is the currency of our country, India. And this is the exchange rate. How to interpret this? This is how many units of INR or the code currency is required to buy 1 unit of the base currency or USD, or in simple words 82.6870 rupees INR is required to buy 1 USD. Okay. Now you can invert this, you can flip it to get INR USD. Here INR is the base currency and USD is the code currency, and this is the exchange rate. So now what this says is 0.0121 units of American dollars or 0.0121 American dollars is required to buy 1 rupee. Okay. Now this exchange rates keep on varying. Okay, it keeps on varying. At the time of creating this video, the exchange rates were these, and so I had noted them down. Okay, if you check today, now these values will be different. If you check tomorrow, the values will be different. All right. Yes. Now proceeding further, we have 8 major currencies: the US dollar, euro, Japanese yen, British pound, Australian dollar, Canadian dollar, Swiss franc, and New Zealand dollar. Okay. Using these major currencies or having these as one of the currency in a currency pair, we have major currency pairs. Okay, major currency pairs. Major currency pairs that are traded in the forex market are these: GBP USD, USD CAD, and so on. Okay, you can pause the video and you can look at it. The ones on the left are base, ones on the right are code. Okay, as I have explained. Now if you notice each pair, what you can see is the USD is common. If you can see or notice, USD is in every pair. So a major pair is the one in which there is a USD. Okay, so this is major currency pair because it has USD in it. This is major currency pair because it has USD in it. This is major currency because it has USD in it. Not only that, but the other currency in this pair is from the list of major currencies. If you notice here, we have GBP, we have GBP. Okay, this is a major currency. If you see here, CAD is Canadian dollar. Alright, so one of these along with USD makes major currency pair. Okay, now what do you mean by major currency pair? These are the pairs which are traded in high volume in forex market. So you can find high liquidity in these pairs. Okay, so these are the most widely traded currency pairs. Now you may have a question in your mind. This is GBP USD. What about USD GBP? Okay, this is GBP being base, USD being quote. What about USD GBP? What about CAD USD? What about USD AUD, and so on? Actually, they have a convention, and this is the convention. Alright, this is the priority they give for the major currency pair. If a currency pair has euro in it, then euro will be the base currency. So if you look here, we have euro and USD. So euro is top of the list, and so euro is the base currency. Then GBP. If GBP is in the currency pair along with any other, GBP will be first. So you can see GBP in the beginning. Okay, first. Next is AUD and so on. Okay. If there is a pair between EUR and GBP, then EUR will be base, GBP will be quote. Alright. Now here if you see, we have EUR and USD. EUR is on the top of the list and we have USD. So first would be EUR according to this priority and next would be USD. Alright. So these are the 7 major currency pairs. Next we have what are called as minor currency pairs. These are also called as crosses. Now these pairs are made from major currencies except USD. Okay? If you see here, we have Euro, GBP, JPY, CHF, AUD and CAD. All these are from the list of major currencies. But then we do not have USD here. So, if a currency pair has both the currencies from major currencies list except USD, then it would be called as minor currency pair. Okay. So minor currency pairs also have liquidity but not as much as the major currency pairs. Okay. USD, American dollar, is called as reserve currency. Reserve currency because it is most widely used or accepted. Okay, and a currency along with USD is called as a major currency pair. Without USD, what we have is minor currency pair. Then at last we have exotic currency pairs. Now these are only 4. Okay, these are only 4 which I have listed out. There are many others too. Okay, there are many others too. Now what is this? An exotic currency pair is a pair of one major currency and one currency of a country which is developing. Okay. So here we have USD. USD is a major currency. One major currency along with the currency of a developing country. HKD is Hong Kong dollar. So this country is considered as developing country and so this pair is called as exotic currency pair. USD, American dollar, major currency along with INR, Indian rupee. India is considered as developing country. So the currency of this country along with major currency is called as exotic currency pair. GBP along with INR, USD along with Mexican peso, MXN. Okay, Mexico is considered as developing country and so this is an exotic currency pair. There are many others too. So a currency pair with one major currency and a currency of a developing country is called as exotic currency pair. Okay. Now people do not trade exotic currency pairs much. So you will not find high liquidity here. High liquidity here. And the pairs tend to be volatile. Alright. So you have to be careful if you are planning to trade in this. Alright. Yes. I hope you have understood the concept of base currency, quote currency and quote value and different types of currency pairs. So that's it for this section. In the next section, we will learn what spread is. I'm going to take an example and explain you what a spread is. This is a shop and this is the shopkeeper. Let us say that this is a vegetable and fruit shop. This is a lady. This lady has grown apples. She has grown apples. Now she wants to sell the apples that she has grown. So what she does is she goes to the shop and says that she wants to sell the apples for a reasonable price. The shopkeeper says that, all right, I will buy your apples at 80 rupees per kg. Okay? If you are from a different country, you can use different currency here. So the shopkeeper says that he is willing to pay 80 rupees per kg of apples. So this lady is happy with the price. So she sells all her apples to the shopkeeper and leaves with the price, money. Okay. Now this shopkeeper has the apples grown by her in his shop. This is a person who wants to buy apples. So what he does is he goes to this shop and says that he wants to buy apples. This shopkeeper says that the apples are for sale at cost of or price of rupees 100 per kg. So if this person wants to buy 1 kg of apple from this shop, he has to pay 100 rupees. Okay. So this person is also fine with the price. So he pays 100 rupees and buys the apple and leaves the shop. Okay. If you see this transaction, you can see that the shopkeeper bought the apples at this price and sold the apples at this price. Correct? There is a difference of 20 rupees. There is a difference of 20 rupees, which is 100 minus 80. And this difference is called as a spread. Okay? The difference of price between buying and selling is called as a spread. And this price at which the shopkeeper bought the apples is called as bid price, and this price at which the shopkeeper sold the apples is called as ask price. Okay, so bid price and ask price, and the difference between ask and bid is called as a spread. Okay, I hope you have understood it. Now this is the way by which the shopkeeper makes profit, by having difference between ask and bid price. So 20 rupees per kg is the profit of shopkeeper. Alright? Yes. So now let us move to the world of Forex. In the Forex market, you will see something like this. Okay? This is the currency pair, USD INR. This is base currency, this is code currency. You already know that, correct? With the currency pair, you will see two prices. This is one price, this is one more price. Okay? What is this? This is bid price and this is ask price. Now, what are bid and ask prices? I just explained it to you with an example. Correct? The ask price, the ask price is at which a broker or the shopkeeper is willing to sell. A bid price is the price at which the broker or shopkeeper is willing to buy. Okay? Now let us leave the concept of shop and shopkeeper aside. Let us come to the world of Forex itself. How to interpret this? You can interpret it like this. If you want to buy 1 USD, you will have to pay 82.701 rupees. 82.701 rupees. This is the ask price. Okay, if you want to buy 1 USD, you will need to pay this much rupees, Indian rupees. Whereas, if you want to sell 1 USD, you will be paid 82.696 rupees. If you want to sell 1 USD, you will be paid this much rupees. And the difference between this and this, which is 0.005 in this case, is called a spread. Okay? The difference between ask price and bid price is called as a spread. Alright, I hope it is clear. Now let me give you a few more examples. The price we pay to buy the pair is called as ask price. Remember this. The price we pay to buy the pair. Which pair? Any pair. The price we pay to buy the pair is called ask price. Whereas the price at which we sell the pair is called as bid price. Okay? And remember that always ask price will be greater than bid price. Okay? Ask price will be greater than bid price. So let me take one more example. You will see something like this along with two prices. Okay? Now what you must remember is the one which is higher amongst these two will be the ask price, and the lowest or the lower value will be the bid price. So here this is higher value, this is lower value. So you will buy the pair. Which pair? This pair. You will buy the pair at ask price. Okay? Whereas if you want to sell a pair, or you want to sell a pair, which pair? This pair. Then you will have to sell it at this price, bid price. Okay? And this minus this is the spread, and here we have 5 points. What is this? We'll see in the next video. Okay? I hope it is clear. The difference between the ask price and the bid price is called as a spread. Alright. So that's it for this section. In the next section, we will learn what a pip is. Okay? Pip stands for percentage in point or price interest point. 1 pip is equal to this much. Okay? 0.0001. So at the fourth position we have 1. Okay? What is a pip? Pip is the smallest unit of price change in a currency pair. Okay? It is the smallest unit of price change in a currency pair. Now, I am from India. Currency of India is INR or Indian rupee. Let us say that I trade this pair, Euro USD. Okay? Now, if I make profit or loss, in what currency will my profit or loss be? Will it be in rupees? Will it be in euros? or will it be in USD? How many rupees do I make profit, or how many euros do I make profit, how many USD do I make profit? So it gets confusing, correct? It gets confusing. So some standardization is required, and to standardize it we have PIP. PIP is used to calculate profit or loss. Okay. Now let us say that this is the currency pair I trade. Let us say that I bought this pair at 1.0842, and after some times I sold this pair at 1.0848. So the difference between these two would be 0.0006, and this would be 6 pips. Okay, so my profit in this trade would be 6 pips, whereas if I had sold this pair at this value and if I had bought the pair at this value, then 6 pips would have been my loss. Okay, 6 pips would have been my loss. So this is how you can calculate your profit or loss. The unit or the smallest unit of price change in a currency pair is called as a pip, and it is used to calculate profit or loss. Okay, let me take few more examples. In the previous video, I had showed you this. Okay, I had showed you this. I had told you that if you want to buy 1 USD, you will have to pay this many money in rupees, whereas if you want to sell 1 USD, you would be paid this many rupees in exchange. Okay, so I had explained you what a spread is in the previous video. So here the difference between ask price and the bid price is called as a spread. You know that, correct? The spread can also be told in terms of pips. Generally, it is told in terms of pips. So here the difference between these two, which we call it as spread, is 0.005. 0.005 is 50 pips. So the spread here is 50 pips. Okay, so this is how you can mention the spread. Now everything was working fine with the pips, but then to make the value more accurate, pipette or point was introduced. Okay, now 1 pipette is equal to this much, 0.00001. In pip we had 3 zeros, in pipette we have 4 zeros. Okay, after the dot. Now why do we require this? You see, the currency pair, the value of the currency pair doesn't move too much. Okay, it doesn't move too much like it does in stocks or derivatives. It only varies by a very small amount, and that is why to have an accurate value, pipette was introduced. Okay, now in the previous video I had explained the meaning of this, correct? This was the ask price, this was the bid price. The difference between ask price and bid price is called as spread, and the spread here is in terms of pipettes or points. Okay, So 1.12507 minus this would be 5-point difference. Now what is a point? Pipette. What is a pipette? Point. So pipette and point are the same. One pipette equal to this much. So here we have a difference of 0.00005, and that is why the spread is of 5 points or 5 pipettes. Okay. Now when calculating pip difference, we generally neglect pipette. All right. So let me go to the trading view platform and show you how it looks like. All right. So I'm in the trading view dashboard, and here you can see Forex pairs, and you can see some values in front of the pairs. So let me click on one. Okay. Let me just click on one. So here you can see the quote value 1.2690. The last value that you see here, okay, the fourth digit after the dot is pip. Okay, so it is 2 right now. All right, the pipette is what you see here written in small font. Okay, small font size. So 9 is the pipette now, 7 is the pipette now, 0 is the pipette now, 2 is the pipette now, and so on. Okay, here too, let me click Euro USD. 1.0855 is the quote price. Now it is 6. This fourth digit after the dot is pip, and the fifth, what you see here up, is pipette. All right. Yes. So that is all that you need to know now. Okay. That's it for this section. In the next section, we will learn what a lot is. All right. Now, before I tell you what a lot is, I will give you an example. Okay. Now, here you can see 5 playing cards, right? Suppose if I want to buy only this playing card from a store, can I do that? Can I buy only this card, or can I buy only this card? No. Correct? Even if I want to buy a single card, I need to buy a pack of cards or a deck of cards. Okay? In which there will be all the suits. Got the idea? Even if you want to buy one, you cannot do that. You have to buy the entire pack. Now, apart from this example, there are many others too, where you will have to buy the entire group instead of buying individual. Okay? If you can think of any example, do leave it in the comment below. Alright? Now, this is called as a lot in Forex. Okay? The pack, entire pack is called as lot in Forex. So what is a lot? A lot is the number of units of the base currency in a currency pair that are being bought or sold. Okay. Now let us go in detail. We have 3 types of lots, but some brokers also provide one more, so we will consider 4 types of lots. First one is a standard lot, and the size of standard lot is these many units. All right, 1 lakh units. So 1 lakh units of the base currency is called as one standard lot, and it is denoted by 1.0. Okay. Now, let me go in detail. If you are trading USD JPY pair, and if you buy one standard lot, then you are buying 1 lakh units of the base currency. Okay. If you buy this pair and if you buy one lot, then you are buying 1 lakh units of base currency, which is nothing but 1 lakh dollars. In the same way, if you buy this currency pair and if you buy one lot, then you are buying 1 lakh units of base currency. In this case, Japanese yen. So you are basically buying 1 lakh Japanese yen. Okay, so this is standard lot. So you do not have a say. You cannot say that you want to buy $23 or 346 yens. You cannot say that. You will have to go by the lots. Alright. Next, we have mini lot. Mini lot contains 10,000 units of base currency. Okay, it is denoted by 0.1. Now, if you are trading this and if you buy one mini lot of this currency pair, then it means that you are buying 10,000 units of base currency. Okay, if you are trading this and if you buy or sell one mini lot, it means that you are buying or selling 10,000 units of base currency. Alright. Next, we have micro lot. Micro lot has 1000 units and it is denoted by 0.01. Meaning, if you trade this currency pair and if you buy one micro lot, you are buying 1000 units of base currency. If you buy or sell this currency pair and if you do it by one micro lot, then you are buying or selling 1000 units of this currency, base currency. Okay. And finally, some brokers also offer nano lot. Okay. Nano lot contains 100 units and it is denoted by 0.001. Meaning, if you buy one nano lot of this currency or this currency pair, then you are basically buying 100 units worth of base currency. Alright. Now, depending on the lot size, your profit or loss varies. Okay. Now, let's do a calculation. Let's see how much does a pip cost according to lot sizes. Alright. Let us say that you are trading this currency pair and this is the exchange rate. Alright. Now, let us say that you buy one standard lot of this pair. How much is one standard lot? 1 lakh units. 1 lakh units of what? Of the base currency. So you are buying 1 lakh units of USD. How much money do you have to pay? To calculate that, multiply 1 lakh by the exchange rate. So you will have to pay this much money. Okay, this much money. Now, you don't really have to pay this much money because we have concept called as leverage, which we will learn later. But for now, let us assume that you have to pay this much Canadian dollar. Okay. Now, when you bought this, the rate was this much. Let us say that this moves up to 1.12165. So from 55 it moves to 65. Okay, it changes by a pip. If it does, then the contract value would be this into the new exchange rate, which is this, which will come to 112,165 Canadian dollars. Okay, so your profit would be this minus this, selling price minus buying price. So this minus this, which is 10 CAD. Okay, so one pip movement got you this much rupees. Of course, there are fees, okay, brokerage cost. I'm neglecting all those, but to keep it simple, let us say you earn this much. If the price had moved down by one pip, then you would have lost this much money. Okay, so this is how much you earn if you buy one standard lot. Okay, now if you had bought a mini lot, then your profit would have been 10 into 0.1. 0.1. What is this? I hope you remember. Mini lot is denoted by 0.1, correct? So 0.1 into 10 CAD, or in other words, mini lot is 10 times lesser than standard lot, correct? So this would be your profit, or the pip value would be this much. If you had bought micro lot, then your profit would have been 10 into 0.01. And in the same way, if you had bought nano lot, your profit would have been 10 CAD into 0.001. Okay, so this is how we calculate pip value. Pip value is always represented in quote currency. Okay, so I hope you have understood. You can buy only in lots in Forex market. You can buy any number of lots. You can buy 2.5 lots or 100 lots, 1000 lots, or 5 mini lots, 10 micro lots, whatever it may be. You can buy it. Okay, but you have to buy it in lots. Alright, so I hope the concept is clear. This is it for this video. In the next video, we will learn what leverage is. Okay. Now, in this section, we will learn what leverage is. Okay. Leverage is the loan that your broker gives you to trade. Okay, it is the loan that your broker gives you to trade. Now, when I say loan, it doesn't have any interest. It is not that kind of loan. Okay, it is just the money that your broker gives you to trade. Now, why does your broker give you money? Because he wants you to trade. He wants you to make profit or loss, unfortunately. Okay, but when you trade more, your broker earns more. So when you make profit or loss, you are paying your broker a small amount. So to encourage you to trade, the broker gives you money, and this money is called as leverage. Okay. Now in the world of forex, the movement of price is very small. So for you to make substantial amount of profit, you need to have a lot of money in your trading account. But generally, people do not have much money. So the broker gives people money to trade in the world of forex. Okay, so basically, leverage is the loan that you are getting from brokers to trade the currencies. Okay, now this is how we mention leverage, or this is how the brokers mention leverage. Okay, so let me explain each one of these. The first one is no leverage. 1:1 means the broker is not loaning you any amount or is not giving you any extra money. Okay. Now, let me take an example. Let us say that you want to buy one standard lot. Okay. And to buy one standard lot, this is the amount required. Okay. Now, rupees or dollars or whatever it is, it depends on the currency pair. Okay. Here I have taken rupees. Let us say that to buy one lot, you need this much money. Now, if your broker does not offer you any leverage, or if this is the leverage, then margin requirement is 100%, meaning you need to have this much rupees in your account to buy one lot. Okay, you need to add this much money to your account to buy one lot. Okay, so that is the meaning. If you have this much money, you can control this much money. If you add this much money to your account, you can buy one lot which is worth this. That is the meaning. Now, if your broker offers this leverage, then it means the margin required is 50%, meaning whatever money you add to your account, broker will give you exactly same account. Meaning, if you add 1 rupee to your account, broker will give you 1 rupee and it will be 2 rupees in total, and you can control 2 rupees worth of currency in the market. Okay. For example, if one lot requires 1 lakh rupees, all you need to have in your account is 50,000 rupees. Remaining 50,000 rupees will be given to you by your broker, and that is this leverage. If this is the leverage, if 50:1 is the leverage, then the margin requirement is 2%. Meaning, if you want to trade this much worth of currency, then you need to have only this much in your account. Rest will be given to you by your broker. Okay. If this is the leverage, you need to have only 1% of the money in your account. Remaining 99% will be given to you by your broker. So if you want to trade this much worth of currency, you need to have only 1000 rupees in your account. Remaining will be given to you by broker. If this is the leverage, this is a very high leverage, but some brokers do offer this. If this is the leverage, then you need to have only this much or only this much in your account to control this much rupees. Okay? And in Forex, if you trade with a lot of money, your profit will be a lot. Same goes with loss too. Okay? So your profit or loss depends on the amount of money that you trade with. Alright? So I hope the concept of leverage is clear. Now, one more thing that I want to mention is, if you have a broker who gives you this much leverage, and if you add this much money to your account and start trading, then if your loss reaches this money, if your loss reaches this amount, then the broker will close the trade. Okay? The broker will not allow your account to go negative. So if you just have 100 rupees in your account and you are trading, and if your loss reaches minus 100, meaning if your loss is 100 rupees, then he will stop or cancel or close the trade, and your account will be back to zero. Clear? Yes. So I hope the concepts of Forex are clear to you. I want you to look at the videos made by other creators on Forex. Learn more about Forex before you start trading. Okay? So this is it for this video. I'll see you in a different video. Till then, take care and thank you for watching.